Equity Mates.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, a podcast where we break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going, bro?
I'm very good, Bryce. Episode 42. Excited for this one?
Yeah, Swans heavy loss last night.
Yeah, we're recording on Saturday the 21st of April, and the Swans went down to Adelaide last night. So, sad day for all of the country, really.
National mourning.
Yeah.
All right, so last week, the last episode that we put out was my interview with Matt Leibowitz, who was the CEO of Stake. Unfortunately, you couldn't make it, Ren. It was a face-to-face up in Sydney. You were down in Melbourne. Logistics just didn't make it happen. But something that we're pretty excited to give to our listeners is an opportunity to sign up through them and then get a $25 referral bonus. We didn't mention this in last week's episode with Stake. It's something we've been working on with them since, but we're happy to announce that we've teamed up with them and they're giving you the opportunity to sign up a funded account. So you need to sign up through them and then put some money in the account to start trading, and they will give you a $25 bonus into your account to help get you on their way. So pretty decent, Ren. What do you reckon?
Yeah, very decent. It's probably worth saying though that we are big fans of the product.
Yep.
It's we are deciding to partner with them because we're both going to use the product.
Yep.
For people who haven't listened to the interview, they offer Australians who want to invest in the US market brokerage-free transactions. So, the $20 you pay to CommBank or the $8 you pay to IG, you get to keep that. The Stake don't charge you anything. So it's a great platform for investors, and we're pretty stoked to be able to offer on top of that free brokerage $25 towards your first investment.
Yeah, it's an absolute no-brainer. The sign-up process is incredibly easy, and the user interface of the whole website is really enjoyable, and it's a great opportunity to get involved in the US stock market, if one of the biggest, if not the biggest, stock markets in the world, with some of the biggest companies in the world. So now's your opportunity to start investing in US stocks.
The most important part, we need to tell them how to get there.
Yes, so we go to equitymates.com/stake, STAKE, not the meat. And then there's a link on there that will take you through to their site, and you can just follow the sign-up instructions. So that's equitymates.com/stake for brokerage-free trading in the US and $25 top-up, which I worked out to be at the moment about 1.6% of an Amazon share.
Yeah. Now, one last question. Is there a minimum that they have to top up their account before they get the $25?
There is no minimum from my understanding. You just have to fund the account, but I know that there's a minimum transaction that you can do of $50, so you can't buy anything for less than $50. That's something else worth mentioning, that one of the really good features of Stake is that you don't have to buy entire shares. If you want to buy Amazon, but you don't want to spend $1,500 doing so, you can buy a partial share. So you could spend $100 on an Amazon share if you would like and own part of an Amazon share and still get access. So that $25 really does go a long way to helping you buy partial shares. So fund it, get your $25, and then you're on your way.
So for this episode, we thought we would do something a little bit different, just because a lot's been going on. We've been churning out the episodes. There's a lot of loose ends, a lot of things that we've spoken about that, have developed further since then. So we thought it was time for a catch up.
Yeah, Ren, let's catch up. I haven't seen you for a while.
Yeah, this is like Hamish and Andy's jazz chat, if anyone remembers that.
Except we don't have any nice jazz in the background. We could figure something out.
We can't afford that.
All right, well, let's catch up. What do you got?
So the first one, I was thinking about the bull and bear episode we did, and we were talking about how the market had fallen, and we were in a correction, and that we might be heading towards a bear market. But I thought it would be worth getting some perspective, because when the markets closed in the end of December last year, to where they closed on Friday the 20th, so we're recording on the Saturday.
Is this us, the Australian markets or the US?
So I'll start with the US,
Okay.
but they're almost exactly flat. So the
wow.
S&P S&P 500 closed on the 29th of December, which was, from what I could tell from Google, the last trading day in America, 2,673 points. It closed on Friday, 2,670 points.
Wow.
The Dow Jones, 24,700, and the Dow on Friday, 24,400. So for all of the, the talk about the crazy start to the year, we're basically flat. So there's a lot of noise, but sometimes we just need to relax, calm down, and get out of the day-to-day hustle. The Australian market has trended down a little bit, so flat in the US, a little bit down in Australia.
So we're down even after. So we had our correction, came back up a bit, but then we've sort of slumped a bit further. Or you're saying we're down based on the close in December?
Close in December, yeah.
Right. And it's interesting. Does that still mean that we're at record highs though?
No, because the record highs were in like early Feb, late Jan.
Okay.
And before the correction.
Right.
Yeah.
Because we did recover after the correction.
Yeah, but then it fell again. So
and then we're bust again.
Yeah.
Interesting.
Now,
So what does that mean for you, I reckon? What has it changed your view on anything?
Not really at this stage. I think just, still try and find companies that I think are cheap or that I think will grow a lot into the future. And when I don't have that, putting some cash away and putting some money in the index, business as usual.
Yeah, I've been thinking about the index thing lately because, as I've said a number of times, I've got some cash sitting in the sidelines waiting for something to happen. And I keep thinking to myself, man, it's probably a good idea just to have it sitting in an index for the moment, at least doing something. But then in conversation with Matt, in the interview we had with Stake last week, and I know you haven't had the opportunity to listen to it, but he was saying that, all this volatility that's come back since February is really meaning that the whole index thing that everyone's been so infatuated with over the last sort of 8 years, it's probably not a strategy that is going to be as successful as it was. And that, he reckons this year is going to be all about the traditional stock picking, just by nature of the volatility that we're seeing at the moment. I don't know if you have any thoughts on that.
Oh, look, he's a very smart guy. I don't want to argue with him. I think that the intention behind index funds and ETFs to begin with was you put it in the market long term and you get the market average rate of return over the long term. I'm sure he's right that when markets are choppy and volatility's back, ETFs might not be the best place to put your money because markets are choppy. But, I think, as we always say, over the long term, the market averages, 7, 8, 9% compounding per year. And that I don't think anyone thinks that's going to change over the long term.
Yeah.
So as long as you're willing to set it and forget it, I think they're still as logical as they've ever been.
Anyway, well, speaking of long term, I've got a little bit of an update. This year marks the 20th anniversary for Amazon on the stock market, being a public company. So they floated back in, what does that mean, 1998?
There you go. That's that maths that we come and listen to the show for.
And Bezos's letters, we've got the Warren Buffett shareholder letter that's sort of now an institution in its own. And it seems that Bezos is now sort of starting to attract just as much attention. Obviously, he doesn't fill stadiums for his annual general meetings, but his letters certainly do attract a lot of attention. And last week, he released his shareholder letter updating everyone on the progress of Amazon over the last sort of 12 months. And he did a bit of a retrospective and looked at the last 20 years. And interestingly, every year he releases his shareholder letters, he includes an attachment to the very first shareholder letter he wrote back in 1998, which he entitled Day One. And he still says that each shareholder letter he releases, he still thinks of it as Day One because his values and sort of way that he sees the company being run and his ambitions are still the same as they were 20 years ago when they first floated, which is just a solid sort of pursuit of customer service excellence, I guess. But some interesting points from the letter. So I just thought I'd bring out a few. He went over and highlighted some of the major achievements that Amazon have gone through over the last 12 months. And, this is speaking of long term, I think it's still a really good long term investment, or even if they are sort of $1,500 at the moment. So Amazon Prime, which is their subscription service, has now ticked over 100 million members globally. And they pay $99 a year. So do the maths on that in terms of what revenue they're getting. But I think that's a pretty phenomenal number. And in 2017, for the first time in company history, more than half of the units sold on Amazon Marketplace were from third-party sellers, which I think is quite interesting. And over 300,000 small businesses in the US started selling on the platform in 2017 alone. So they're creating this huge opportunity for businesses to get on and access markets that they probably would have otherwise struggled to do. Amazon Prime Video has acquired some pretty amazing rights this year. They've got The Lord of the Rings and some TV series from Spielberg coming through. But then interestingly, Amazon.India is the fastest growing marketplace in India. And I think we'll touch on India a bit later on this episode. And Amazon.India is the most visited site on both desktop and mobile in India. And their mobile app was the most downloaded in India ever. So they're smashing it over in India. And Jeff Bezos can't do a handstand.
What? There you go. Well, neither can I. So maybe I'm the next Bezos.
So some pretty amazing figures there. And I think it's just highlighted that, they're ticking away. They've got so many things. They've got Amazon Web Services. They hire over 560,000 people around the world now. They're a phenomenal company. And I think I still have a really strong buy on them, I think. What are your thoughts, Ren?
To be honest, I'm not as bullish on Amazon as you are. There's a lot of stuff coming out about their conditions in their factories. People die because of and that's not an exaggeration, there have been deaths. Yeah, because of the conditions that they put on their workers. Heaps of dehydration stories have come out where workers...
Wait, in the States? Or?
Yeah, in the States, in Europe, everywhere. Yeah. People faint from dehydration, and the workers, the KPIs are too strict that they don't even stop to look after the workers that have fainted. It sounds like a messed up environment. Yeah, so the story is that, and obviously this is all third hand from, articles that I've read and stuff, but Amazon are looking to replace a lot of their workers with robots pretty quick smart. But it's an interesting one because obviously part of the reason they can keep prices low is they keep their costs down, and part of that is operating at massive scale and massive efficiency. But it seems like that is taking a human toll, I guess. So
I didn't know that.
Yeah, so that I'm not very bullish on. The second thing, it's interesting you talked about India because Amazon, although Bezos might paint a rosy picture in his shareholder letter, Amazon's actually in probably one of their toughest fights, at least one of their toughest recent fights, with Flipkart in India. And Flipkart is the Indian incumbent over there, and something recently that has put a new dynamic into this fight is that Walmart have just offered $12 billion to buy 51% of Flipkart. So Walmart are taking their battle with Amazon global, and that would be a fascinating shift in dynamics if it becomes Amazon v Walmart in India, but
absolutely,
Walmart has the local incumbent's knowledge on their side. So that's something that I'm really interested in, and I guess because of our partnership with Stake, and you can, if you sign up through our website, you can get a free $25. So my question for you is, if you had the $25 now through Stake, who would you buy, Walmart or Amazon?
I would be going Amazon.
I thought you would as much. I'm going to take the contrarian view. I reckon Amazon is priced to do so well, and I don't doubt that they will do so well. But Walmart, Walmart pulls in $500 billion in revenue a year. That's half $1 trillion in revenue. They're obviously looking to expand globally. They bought Asda in the UK a few years ago. They're now going to India with this Flipkart move. But one dynamic that I reckon will be really interesting is, how Toys R Us just declared bankruptcy in America, and other retailers like Macy's and stuff are really struggling. I'm really interested to see where those holes in the market get filled, because Walmart, a lot of people, the obvious choice is Amazon. People will buy their toys online rather than at Toys R Us. But I think Walmart can become a massive player in a lot of those spaces. Amazon could become Walmart could become the physical toy retailer that Toys R Us used to service.
Yeah, I guess one of their major advantages is that they've got the bricks and mortar footprint, and something that Amazon doesn't have. So yeah, I don't know. I think you're right. There's massive potential, and they are a massive company. But from what I've been reading, the deal with Flipkart isn't clear cut. Like eBay has a 5% stake in Flipkart, and they have they did have an agreement, a commercial agreement. So Walmart are going to have to work through that, and there's a few other stakeholders in Flipkart that are going to provide sort of some legal hurdles for Walmart to come in. So it's not, yes, they've sort of put the deal on the table, but whether or not it actually goes through is another question, because it sort of seems like there's a few hurdles in the way.
The biggest one is Amazon has also announced that they want to, or there's rumors that Amazon wants to buy Flipkart as well. So
maybe Amazon will just buy Walmart.
I don't think maybe if that was the case, then you'd definitely want to own either shares, I guess.
Yeah.
So yeah, look, that's an interesting one. Well, we might do a catch up part 2 for our next episode where we will talk about what you want to talk about. I've got some loose ends I want to tie up, and we might talk about some books and stuff that we've read recently if we have time.
Yeah, nice. Let's do it.
If we don't spend 12 minutes talking about Amazon again.
So good. All right, Ren. Well, sounds good. Let's do it.
Yeah, and if you haven't already, while you're listening to our episode, make sure you sign up to Stake, equitymates.com/stake.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mates.